Hello guys, welcome back. Today we are going to discuss the term what is revenue recognition or when we are recognizing the revenue in income statement. This is me Rabeeh OVUNGAL. Welcome back to EduCafia. Yes, we are very familiar with the word revenue. And we know when to do the revenue or when to write revenue in income statement, or when is revenue is recognized. Is all the payments we can call revenue? No. So there are many terms and conditions to meet to call the amount as revenue. There is a principle for revenue recognition. It is called the revenue recognition principle. It is to recognize revenue in the accounting period in which the performance obligation is satisfied. If you got payment and if performance obligation is satisfied, then you can recognize that payment as revenue. If performance obligation is not satisfied, then you can't call that as revenue. It will goes to balance sheet. Okay, a performance obligation is satisfied means what? What is a performance obligation satisfaction? It is nothing but the customer is obtaining the control of the asset. What is control of the asset? What is mean by the customer is obtaining the control of the asset? It is nothing but the customer is obtaining the right to use of the asset. The customer will get the right to use that asset, plus the customer will have all the future economic benefit of that asset. Okay, these two things. First one, the right to use the asset. Second one, the economic benefit of all the economic benefit of that asset for that customer. This is nothing but the customer is getting the control over the asset. This is nothing but performance obligation is satisfied. This is nothing but we can recognize that amount as revenue. You got it? This is the principle, not a standard. Okay. There are two types of there are two types of contract, asset and liability. I mean, when it is not recognized as revenue, but we got the payment, then we can call that contract asset or contract liability. There are two terms. One is contract asset, one is contract liability. What is contract asset? Contract asset is nothing but we are building a building. Here we are building a building for our customer, but not yet the customer paid us a single money. For our customer, we are building a building for him or her, but we are not yet got any payment, but we are building. First floor is okay, second floor is built, third floor, fifth floor we are building. It is an asset for me. For my company, it is an asset because tomorrow if I sell this building, I will get payment. So for me, it is an asset for me. But this customer is giving me advance amount. Construction is going on of that building. Construction is going on. I am the contractor. I am constructing the building. I am not yet given this building to them. I am not yet given the control of the building to them. Construction is going on, but I got advance payment. This advance payment for me is a liability. It's a liability, right? Because otherwise I have to give this advance payment back to him. Otherwise I have to give this building control to him. Once I have two options for me. I can give back this amount. Otherwise I have to satisfy this performance obligation. That's why this is liability. So that is contract liability, and otherwise it is contract asset. So I understood what is contract asset and contract liability. This contract asset is an asset arises when a company has performed work. Company has performed work but has not yet received payment. I have not received any payment. This is contract asset. This contract asset is divided into two: unconditional contract asset and conditional contract asset. Unconditional contract asset is means every work is finished. Directly I can take the money and recognize as revenue. Every work is finished. As per the contract, as per the agreement, I have completed all the work. Now directly I can ask for the money and I can recognize it as revenue. That is unconditional. There is no condition pending for receiving that payment as revenue. If it is conditional contract asset means some of the condition I have satisfied, but something is pending. If I receive the money, some condition is pending. For example, I am selling TV, big 100-inch TV. Before it was like a TV usually have stand, but now TV are like we have to fix in the wall. Usually now TVs are like fixing in the wall. So I am selling the TV. One customer came to my shop and I sold the TV. But one more condition is there: free fixing to wall, free fixing wall. Because if I sell this, I will fix this TV in his or her house in the wall. It is also included in the price of this TV. Then one of the obligation is satisfied. What is that? I sold the TV. Now the control of the TV is for that person only. But what is the second condition? Second condition means I will go to her or his house and I will fix that TV for them in the wall. That is also pending. So because of that is pending, I can't recognize this amount whatever I received as revenue. That is contract asset. You got it? So that is conditional contract asset. You got it? So I hope you understood what is the difference between conditional and non-conditional. If it is unconditional contract asset, directly I am having the right to take it as revenue. So if it is a 1 lakh amount, that's 1 lakh amount I will show in my sales revenue and it will goes to the accounts receivables. Now I am receivable. Now it is receivable for me to get that. If I'm getting the cash means I can directly debit the cash. Because of payment is pending, I am debiting accounts receivables. But if it is directly I am getting the cash means I can debit cash. Okay. Then that same time from my inventory, whatever I am giving, it will be reduced and it will be increased in the cost of goods sold. I sold, right? So under the revenue, I have to show COGS, right? In that COGS, this inventory will come. But if it is conditional contract asset, in this $1 lakh, $18,000 is for TV. And for fixing 20,000, because for fixing that fixing rod is required, labor charge is required, freight charge is required, this much charges is there, that is 20,000. So in this 18,000 I sold the TV, right? That 18,000 I can consider as sales revenue. That will goes to contract asset. Because this is in debited by, this is in asset side, it is there because it's for me as a contract asset. I can't consider it is as receivable. Why it is I can't consider as accounts receivable? Because fixing is not finished, the second condition is there, pending is there. So next day when I went to his or her house, I'm fixing that TV in their wall, balance 20,000 I will show in sales revenue, and previous 18,000 it is there in the contract asset. That will go to together to accounts receivables 1 lakh. You got it? So this is the journal entry in conditional contract asset, and this is the journal entry in conditional contract asset. You got it? If it is contract liability, what will happen? I got the money, but performance satisfaction is still pending. I mean, what is that word? Performance obligation, it's still pending. It is not satisfied. So in contract asset, if I got any amount that something I got right, when the cash advance is received, I got cash right. So I will debit that. Then I will credit contract liability. I want to increase that contract liability in liability side. So if any increase in liability side, that will be credit. So I got 1 lakh rupees. So cash I received. In my liability side, new term will come, contract liability 1 lakh rupees. Rupees or dollars or whatever. When performance obligation completed, when I fixed TV, before fixing TV I got money. So after fixing TV and everything, what will happen? I can consider it as sales revenue 1 lakh rupees. And whatever is there in the contract liability as credit, I will debit it 1 lakh rupees. Okay, that time from inventory, it will goes to cost of goods sold. Whatever, if it is 17,000, it will goes to 17,000 to cost of goods sold. Got it? So when I receive the cash, that time I can't do this inventory to cost of goods sold. It is against matching principle. When I am considering it as sales revenue. Okay, when the performance obligation is completed, that time I will consider it as sales revenue from this contract liability. Whatever is there in the contract liability, I will consider it as sales revenue. The same time, whatever is there in the inventory, I will convert it to cost of goods sold. Okay, this is contract liability and a contract asset. When we can recognize a revenue, there are 5 steps for recognize revenue, for revenue recognition. First one, identify the contract with the customer. As per ASC 606 rule, I want to identify whether this is a contract or not. For becoming a contract, there are some rules and regulations that we will discuss. First of all, I had to identify whether it is contract or not. Next, identify the separate performance obligation in the contract. Like selling TV, first one of the performance obligation. Second one, fixing the TV. Second performance obligation. So I have to identify separate performance obligation in the contract. Third one, determine the transaction price. Determine the separate pricing for TV 18,000, for fixing 20,000 and charging. Total I have charged 1 lakh. So identify separate transaction price. Fourth, allocate the transaction price to the separate performance obligation. Identified 18, 20, then allocate TV for 80, then fixing 20. Fifth, then recognize revenue when each performance obligation is satisfied. When each performance obligation is satisfied, then recognize it. So, first one, identify the contract. When we can identify when it will become a contract? According to ASC 606, a valid contract required creates enforceable rights and obligation. If a contract is there, then there will be creating a enforceable rights and obligation. What is rights? When we are making a contract, customer is getting some rights, and as a supplier, some obligations are made there. Contract is nothing but house construction. House is constructing for the customer. For the customer, what is the rights? In future, they are going to get right on the house. What is my obligation? I have to construct the house perfectly in with the proper design, in proper structure. That is my obligation. So create enforceable rights and obligations. Second one, has been approved by the parties. Both the party. Who are the party? Customer and the supplier. Orally or writtenly. Writtenly means agreement. Orally means when you go into a supermarket and if you are buying a shampoo, I am buying a shampoo means that is also a contract. There you are not writing any agreement, right? I am buying shampoo from supermarket for this price. We are not making an agreement, right? That is happening orally. Clearly identifies each party's rights regarding the goods and service. Clearly identify each party's rights. If it is an agreement, we have to write what are the rights for each parties. If payment is not coming, what to do, when the payments are required, how the construction should be. If we are going to a supermarket, there are also rights for us. The price should not be more than MRP, maximum retail price. Many rules and regulations are there. Next, clearly specify the payment terms. When the payment has to do, payment terms have to be clearly specified. Has commercial substances. Has commercial substances means it changes in the company's future cash flow in terms of risk, timing. The amount will change. That is called commercial substances. Next, a contract is valid. A contract is valid only if it is probable that the company will get the payment. How we will know that we will get the payment? We have to check the credit risk of the customer. If the customer, we understood the customer is not going to pay, then that is not a contract. That is not a contract. There should be a probable that the customer should pay. Okay, for that we have to check the credit risk of the customer. Okay, if these are all there, then we can identify this as a contract. Then what is a performance satisfaction? For satisfying the performance obligation, there are two ways. One is at a point in time or over time. At a point in time means if you are going to a supermarket and if you are buying something like a shampoo or a soap, whatever, if you are something you are buying from a supermarket, at the time of you are getting the material, you are paying. At the cashier, you are paying the amount and you are getting the material. Right? That is at a point in time. If it is over time, like construction of a building, I'm given the construction of a building to other people for a contractor. Construction is progressively happening. So I am getting control of that building progressively. Correct? So that is called overtime. Construction of building, construction of bridge. Revenue is recognized over period as the customer gains control over the asset progressively. You got it? So this is overtime. Second is identify the separate performance obligation in the contract. First was identify the contract. Second, identify the separate performance obligation in the contract. How to identify? If I am, for example, in the case of TV, selling TV is one of the performance obligation. Second one, fixing the TV is another performance obligation. So we identified two performance obligation. Next, determine the transaction price. Contract price, transaction price, two prices are there. In contract, we set one price, that is 1 lakh. If we satisfy the performance obligation, we will get 1 lakh rupees. But it is not sure that you will get 1 lakh rupees. If I am only getting 95,000, I am given discount. Then what will happen? I am given discount. 5,000 is gone, right? So 95,000 is the transaction price. Whatever I am getting in my hand, that is transaction price. So in the contract price, I am having said 1 lakh rupees, but I am getting 95,000 means that is transaction price. So I have to determine the transaction price. So in that price, variable consideration will be there. Significant financing component will be there. Non-cash consideration will be there. What is variable consideration? In this 1 lakh rupees, like 5,000 maximum, there is a chance of giving discount. Chance of giving discount. How much discount I will give? That I have to calculate through expected value method and most likely amount method. Through expected value method, that is probability weighted. For example, in this 5,000, 20%, 2,000 I will give discount, or 10% I will give 1,000, or balance 70% I will give 5,000. If I am saying like this, in most probable method, two methods are there, most probable, which is most probable 70%. In this, I can consider 5,000 discount I will give. If it is not a most probable means, I have to calculate it weighted average. 20% into 2,000, 10% into 1,000, 5,000, 70% of 5,000, some amount I will get, right? Then total of that amount I can consider as expected value method, that is probability weighted average. This amount I have to consider, then balance will be the transaction price. You got it? And a significant financing component. If payment is deferred for more than 1 year, if payment is not happened for more than 1 year, we have to adjust that money for time value of money. Time value of money, present value we studied, right? Present value. So if payment is deferred means if payment is happening after 1 year or 2 year, time value of money is coming down. The contractual price we have written 1 lakh is today's money. If payment is getting after 2 years, we have to calculate the value of that money, present value. That is our transaction price. If it is non-cash consideration, if we are not getting money, instead of money, we are getting goods. If you are getting any services, if you are getting any stock, we have to calculate the fair value of that. Contractually, if 1 lakh will be there, if they are giving us any goods or stock or anything, if the fair value of that 95,000 means, that is transaction price. So we have to determine the transaction price. Then we have to allocate the transaction price to the performance obligation. For example, contractual price is 1 lakh, transaction price is 95,000. TV selling and TV installation, we have to allocate this 95,000 to TV and TV installation. Before TV for 18,000, TV installation 20,000, that is 80% for TV, 20% for installation. So for of this 95,000, 80% how much? That is for TV, and 20% how much? That is for TV installation. Like that, we have to allocate the transaction price. Then recognize the revenue. Now what you can do, you can recognize the revenue. Whatever is the transaction price, revenue is recognized when a company satisfies a performance obligation. So when a customer get the control over the asset, when direct the right to use and obtain all the substantial remaining benefits. When the customer get the control over the asset, we can recognize it as revenue. So these are the 5 steps to recognize a revenue. What are the 5 steps? Very simple. First of all, whether we have to check whether it is a contract or not. Next, we have to find it out, separate performance obligation. Next, we have to find it out, transaction price. Fourth, we have to divide the transaction price to the performance obligation. Fifth, recognize the revenue when the performance obligation is satisfied. Very easy, right? So this is nothing but revenue recognition. So I will pin this note in the description box. You can get it from there, read it. You have to read the textbook is very important. Again and again, I am repeating this word in all the videos, right? That's why it is because it is very important. Because IMA not released any textbook. They are only giving syllabus. Based on this syllabus, all these people, who are the people Hawke, Gleim, Wiley, Sargent, Becker, prepared textbook. Okay, so it is very important to read the textbook. So see you on the next video. Bye-bye.